Hello and welcome. My name is Matthew Webb and today we're here to review the last 12 months. There's been significant news flow, be it inflation risk rising, interest rate rising, indeed we started 2022 with geopolitical risks. We're going to discuss today how the Magellan Global Equity Portfolio has responded to those events over the last 12 months, but also more importantly, how it's positioned today for the days, months and years ahead. With me today is ARVID Strymon and Nikki Thomas, portfolio managers on the global equity strategy. Thanks ARVID and Nikki for joining me.
Hi Matt.
Hi Matt.
You've been working together closely on the portfolio now for 6 months. Can you tell us a little bit how that's been going?
Fantastic. It's lovely being back here, and ARVID and I obviously worked together a little bit sort of 5 years ago, but it's been wonderful to come back, and we have very good complementary skills. And so I think, it's been a really good interaction and great input from ARVID into the whole process to help with the stock selection and the macro piece.
Yeah, from my perspective, I think it's great that Nikki's back here, Matt. And I think that the word that you used there, complementary, is really the word that I would use to describe it as well. We know that Nikki has a huge amount of experience looking at stocks and markets, and while I'm a stock analyst at heart, I probably spend most of my time these days looking at risk and macro. So I think that the two things that we bring together are really important, and I think it's more important than usual right now given what's been going on in the world.
Can you tell us a little bit about how you're working with the team? And we've also just announced a consulting agreement with Hamish Douglass, the firm's co-founder. Can you talk a bit about how that's going to work?
Yeah, totally, Matt. So the team, 30-odd, deeply analytical, incredibly engaged analysts continue to do what they've always done here at Magellan, I guess, and do the hard yards on understanding the companies, understanding the industries, and bringing those great ideas to the portfolio managers. So we continue to be very engaged with that team. They're wonderful and they're very good at what they do. Indeed, you'll see some of them speak on some of the in-review video series that we're running with this. So, definitely look at those because you'll understand just the high quality that we have in the team. On the Hamish piece, so obviously rejoining us in a consultancy arrangement, we will have access to that wonderful mind that has been behind the Magellan strategy for years and be able to talk to him about his thoughts, how he's seeing the world, and be able to tap into that when we need to. So that is something that I think is a real win-win and something we're looking forward to doing.
ARVID, I want to throw to markets now. So if we reflect on the last 12 months, we've had the growth at any price thing kind of get killed back in December, roll forward into year to date through 2022, you've seen something quite unusual. So you've seen markets fall, but you've seen the quality style indices fall by further, which is really unusual in a bear market. On the other side, you've seen energy indices rally by 50%, which again is counterintuitive. Generally, they're pro-cyclical and move up and down more than markets. So can you tell us a little bit about your observations there?
Yeah, sure thing, Matt. So it's, as you say, it's been a very unusual year. And let me start off with the energy piece first, because as you say, it's up almost 50%, the energy index so far this year. And when we look at energy, we look at the sector and it's not really in our investment approach. And there's a couple of reasons for that. The first is that when we're looking at companies, we have this intense focus on quality. And when we're thinking about quality, almost a prerequisite for being a quality company is to have pricing power. And if we think about the oil industry as just an example of the broader energy industry, it's not really the oil producers that have pricing power. In fact, if you're looking for pricing power within that industry, it's actually just OPEC. So I would say that within the energy industry, not many companies have that requisite level of pricing power and therefore quality that we're looking for. But I also want to highlight the cyclicality of the industry. So we know that, again, using the oil market as an example here, oil prices, they're over $100 now. And if we just go back just over 2 years ago, if we rewind 2 years, we know that for some oil prices, particularly in North America, they were actually negative. So you actually had to pay people to take oil off your hands. And so this really speaks to this cyclicality in this industry. So energy prices as a whole, I would say they're relatively high at the moment. And I don't think they're going to continue to keep going up at the pace at which they've been going up. Maybe they level out. But when that does happen, I think that the energy sector is probably going to underperform the broader market. And while we're on the topic of returns from the energy industry, as you said, it's up almost 50% in the past 6 months. But if you look back over a longer period, the past 10 years, that sector has only generated returns of around 5% per year, which includes the 50% over the past 6 months. So over the previous 9.5 years, the energy industry hasn't really been that kind to investors. But let me move on to the quality, and I think you're right. It's fairly unusual that quality companies have underperformed in what is a bear market right now, because these quality companies tend to be defensive, so they tend to have reliable earning streams, they tend to have low leverage, they tend to have high returns on capital. So what's going on? I think the big thing that's going on here is higher interest rates. So within those set of quality companies, there are some companies which are more growthy than others, so they tend to have their profits which are further out into the future than most other companies. And when interest rates go up, these types of companies, their valuations are more sensitive to higher interest rates. And so there's this mechanical link which has dragged down, I would say, parts of that overall quality index that you're talking about. But if we stand back and go, okay, well, what's happened to lower quality growth companies, and there's been a lot of them, well, they've actually been hit by a double whammy. Not only have they had that mechanical negative link to valuation from higher interest rates, but people have also downgraded their expectations of how much profit they're going to make over time, and that's why they've really underperformed. But if we take a step back, it's interest rates which have really driven that phenomenon which you're talking about, that surprising phenomenon. And so I think the question here is, where are interest rates going to go? And if we look at the 10-year bond yield in America, which is probably the key interest rate here, the question is, well, where's that going to go? And I would say the Federal Reserve in America has already told people that it's going to raise interest rates to a level which is going to start constraining activity. And so if they did it even more and they said we're going to raise rates even further, I think people in the bond market would say, well, it's already constraining activity, so I think that the chance of a recession is going up even more if you raise rates further, and so therefore rates on the other side are going to come down. When we're thinking about the 10-year bond yield, you can think of it as an average of interest rates over the next 10 years, so maybe that average in that scenario is unchanged or maybe even comes down. And so the point here being is that it's getting harder and harder for that 10-year bond rate, that key interest rate which has been driving markets, to go up further materially from where it is right now. And so all of these phenomena that we're talking about with respect to quality companies' performance, I think that that drag from interest rates is not going to be as strong as it has been in the past.
I want to stay with you, Arvid, because the picture you've painted is probably related to the way a lot of investors are thinking at the moment. We've started the year thinking about worries about interest rates, geopolitical risks, mainly around Russia and Ukraine and potential contagion of that. Now we're talking more about inflation, stagflation concerns. There's a lot of messages which are difficult for people to digest. Can you lay out a framework about the way that perhaps people should be thinking about that?
Yeah, I think that's a really interesting question, because the thing is there's a lot going on in markets right now, but I think if you look through that, I think there is a normal sequence of events which is being followed at the moment. So let me take you through that. So I think the first sequence, or the first step which occurs, is higher inflation. I think we've seen that already. Okay. Then the next step is that the central banks start to raise interest rates to control that inflation. And when people see that, investors see that, I think investor sentiment starts to weaken. And I think that we have seen that second step already. And I think we're in this third step, and that is when higher interest rates actually start to do their work and reduce economic growth and reduce profit growth. And I think this is the stage where we're at right now. This is the sequence step that we're in right now, because we're starting to see people reduce their expectations for economic growth and reduce their expectations for profit growth. And so when we're thinking about where bond yields go, this is another reason why bond yields are probably going to be, it's going to be hard for them to move higher at the moment because of this slowing in growth. But when we're thinking about how the market's going to perform in that sequencing which I just explained, I think it's going to perform in a very similar manner. In the first 6 months of this year, when interest rates were rising, then I think that was the dominant driver of investment returns. what company is most sensitive to interest rates, and that was really a driver of investment returns and also sector returns and company returns. As we move forward into this environment which I described of slowing economic growth and slowing profit growth, I think that people and investors are going to start focusing not on interest rates and sensitivity, but where is the earnings resiliency? Whose earnings are going to hold up better in this environment? And I think the answer there is going to be, it's going to be those quality companies, those ones with the defensive earnings or the more reliable earnings, which although they've been hit in some places by higher interest rates, looking forward in this new focus on earnings certainty, I think that they'll do a lot better. So when we're thinking about investing in our quality companies, I think we have a very strong level of conviction that we've got some very good companies there. And the last thing I'd say on this topic, Matt, is that if you can find a quality company that has the tail at its back with a very strong long-run industry thematic, then I think you've got a real winner there, and they're the types of companies that we're really looking for.
Thanks, ARVID. Nikki, ARVID's given us a pretty complex macro background, so can you tell us how that's being reflected in the portfolio at the moment?
Yeah, sure, Matt. So I guess, broadly speaking, we're trying to think about what are the things that you want to actually have working for you in the portfolio right now. So we want to have pricing power, we want to have protection from inflation, and indeed, if we can get it, we want leverage to inflation, where companies can make more money on the back of inflation. And we want to stay with that very high quality secular growth thematic. So finding those businesses that we think will outgrow GDP year in, year out for the next decade. Hopefully we can find at least a decade of that sort of growth. So when you think about that and you think about how we're positioned, and it's a concentrated portfolio, it's only ever 20 to 30 stocks, we continue to have very high representation from businesses like Visa and MasterCard, where they clip the ticket on nominal dollars, so they're clearly inflation protected and in fact leverage inflation. Very strong exposure to Microsoft and Alphabet, both with very strong tailwinds behind them around enterprise software and the expansion of digitalisation around the world. Digital advertising continues to take market share, so again, secular tailwinds behind them. And then we've lent forward on really reliable earnings generators, things like McDonald's and Yum Brands, for instance, franchise operations, so they again clip the ticket on top line sales that come through from their franchise operators. They don't get the headwinds of commodity costs to the degree of a typical owned restaurant chain. And so again, we think they will perform well and will be resilient if we go into a period where economic growth gets challenged. So they're the sort of companies that we're looking for and leaning forward on. And looking for where in this difficult market we're starting to see some opportunities throw up where the market's oversold, in our view, businesses that have really strong tailwinds. And so we're starting to look through the weeds for those opportunities that are being presented by the difficult market that we're operating in.
Thanks. You've spoken to what I'd regard as a lot of Magellan staples that our investors know a lot about and think, yes, tick, that's Magellan.
Yeah.
Is there anything in this last little while, there's been a lot of volatility around, that's presented an opportunity to perhaps introduce a couple of new names that maybe people aren't so familiar with that you can talk to a little bit?
Yeah, so I would say there's stocks that have been reintroduced to the portfolio that have been in the Magellan portfolio before. So they are Magellan, in history have been part of the Magellan portfolio. Things like Diageo, which has been owned in the past and is the world's largest spirits manufacturer and is very leveraged to the reopening that's going on across the globe. And last results were 20% organic growth in its business. So we see a really lovely tailwind behind that business, but it's also a very economically resilient business and has extraordinary pricing power. So that would be an example of one that investors would have seen before. A couple that they may not have seen before in a Magellan portfolio, but are absolutely of this level of quality, ASML. So it's the world's almost monopoly provider of EUV lithography equipment, probably the least known monopoly in the world, but it basically sits behind the production of semiconductors. And when you think about the growth in semiconductors as we go into this digitalised world in electric cars and in Internet of Things, the fact that the internet's now connected to your dishwasher and your fridge and all sorts of these gadgets, you need semiconductors for that. And ASML are the leading provider of the leading edge in that semiconductor story. So a business that we've got an opportunity in this market to pick up and put into the portfolio. Another one has been Chipotle Mexican Grill. So for Australians, they would know Guzman and Gomez. Guzman actually copied the Chipotle model. But the Chipotle story is quite simple. It's very high quality Mexican food with a store rollout opportunity that's giving it at least 8 to 10% per annum growth for the next decade at the revenue line, and then operates a very, very efficient model. So restaurant margins are very strong and returns of capital as they roll out these stores are extraordinarily good. So again, a classic Magellan type of investment, but we've been able to start acquiring this at bargain basement prices. So pretty exciting.
Thanks, Nikki. And thank you, ARVID. Thank you very much for joining us today. We hope you found our comments insightful and useful. Please feel free to share this with any of your friends and colleagues, and indeed please feel free to reach out to Magellan should you have any further queries. Please also make sure to check out the In Review 2022 website, which features many more conversations with other members of our investment team.